All right, 2020 was truly an exceptional year in and outside of financial markets. The Nigerian economy has since reopened, and the ravaging impact of the twin shocks, the pandemic, and the downturn in oil prices seem to have dissipated. However, analysts at Cordros feel the cog in the wheels of economic activities will linger in 2021, but still puts forward ways that investors can position in the new normal. Opeyemi Ani, Senior Analyst Research and Strategy at Cordros, joins us now. Thank you very much for joining us, and Happy New Year to you, Obe.
Thank you for having me. Happy New Year.
So a lot of Nigerians' fortunes are linked to the price of oil. What is your view on how the oil market will play out in 2021?
I think we can say the worst is over concerning oil prices, but the recovery, in our view, is quite fragile. Demand is expected to continue to recover as economies continue to reopen and as economic activity picks up across the globe. However, our view is that demand will not return to pre-pandemic levels, at least not before the end of 2021. Especially as we're expecting that the vaccine rollout across the globe will be protracted. For example, we're saying that, the likes of sub-Saharan Africa is not expected to fully be vaccinated before 2023 at the least. So, I mean, right now, the way it's looking is that traders and the market seem to be overly optimistic about this, vaccine rollout and the recovery and demand. And that is why we're seeing that oil prices are now trading at around $53 per barrel. Fundamentals are still very shaky in the market. We've seen that the pandemic is not over across Europe, having every day a record number of cases. So I mean, balancing the market, and I'm looking at OPEC here, is not going to be, a mean feat. It's great that we've seen OPEC Plus and the OPEC Plus coalition come together yesterday and agree that the production cuts will be maintained. They delayed the output increases that were supposed to be scheduled for next month, about 500,000 barrels per day. And we've seen that even Saudi Arabia has come to take on voluntary cuts on their own. So this has instilled more confidence in the market. But in our view, we feel that oil prices do not have significant upside from current levels, especially when you look at the significant spare capacity that OPEC members have in terms of production. We still look at the high inventory levels as well across the globe, and also the risk of shale producers coming back to the market once oil prices are sustained above $50. So overall, we are quite conservative and expect that Brent crude will average around $45 to $50 per barrel in 2021.
Okay. So, Opeyemi, what does this conservative view on oil prices mean for the overall economic growth in Nigeria?
So the first order impact really is around production and oil GDP. Oil production fell last year. This is Nigeria specifically. Oil production fell last year to the lowest level since 2016, 2017. This was, if you recall, 2016, 2017 was during the militant attacks in Nigeria. But last year, the levels, or production levels dropped significantly as Nigeria made efforts to comply with the OPEC Plus cuts. So, I mean, these are being carried into 2021, although there are plans for slight output increases, but, it's negligible for Nigeria. I think it's only about 22,000 barrels per day extra that we can pump out. So it's not significant, and overall, we're only expecting that oil GDP will only grow by about 0.7% next year. So the recovery in growth for Nigeria is really hinged on the non-oil sector. We expect that the service sector especially will drive this. The likes of telecoms have continued to grow every quarter over the last few years, and we expect that to play a huge role here in 2021. It is quite a resilient sector. We see that the telcos continue to expand significantly in terms of network infrastructure, and the subscriber base continues to grow. Patterns changed a lot because of COVID-19. We've seen a lot of technology adoption, as a lot of people move from the office and the workplace to the house to work. So a lot of data traffic increases as well. So seeing as this seems to be a very resilient sector, we expect this to continue to drive economic growth in 2021.
Now, we've seen exchange rates been under immense pressure over the last year. Is there any respite in sight?
So it's a tough one for the monetary authorities and the CBN as well. Despite the two-step, or can I call it the three-step devaluation that we saw across the windows last year, official and the INE window, we still believe that the Naira is grossly overvalued at these levels. Our gloomy view in 2021 on the fundamental picture also leaves little to cheer going into this year. The current account deficit is expected to widen to about 4.1%, 4.1 to 4.3% of GDP in 2021. This alongside our expectations of subdued capital inflows, with the FX liquidity challenges still remaining, as well as the low fixed income yields compared to peers. This should leave the CBN really at the mercy of just the reserves to defend the Naira. So, that isn't enough for us. In our view, our baseline expectation is that the CBN will have to devalue again. We should see a depreciation at the official window to maybe around 400 Naira, which is around 5% devaluation. And then in the INE window, maybe to around 415 Naira to the dollar.
Okay, so what lessons should capital market investors take from 2020, and how should they be looking at 2021?
Yeah, 2020 was a huge test for investors, but I think it was how investors reacted that was very important. Though volatile, many investors did what you're taught as an analyst, buy the dip, and a lot of investors did buy the dip and enjoyed fantastic returns. It's tough, in years where there's crisis, a lot of people tend to make a lot of money. The crisis is abating in 2021. So we feel that investors have to go back to basics in 2021 and be more discerning in order to find the right investment opportunities.
Okay, you're talking about equities market. Now, I want to look at the fixed income market, and we saw, the yield environment in the fixed income market last year, and of course, continuing into 21, very unattractive. But then you would say it performed strongly, in 2020 for perhaps government and corporates. So what direction do you see yields going in 2021, and how should investors be positioning?
So for fixed income, I think it's going to be a tale of two halves for the fixed income market. There isn't much room left for fixed income yields to fall. So I think in the first half of the year, we should see that yields remain in the lower single-digit territory. And then, we should start to see a moderate uptrend to account for the reduced market participation as investors, seek yield and alpha in other asset classes. The latter parts of the year, a combination of that weak market participation, a revision in the monetary policy, where we see that monetary policy might revert to a tightening cycle once the economy goes back into growth, probably around the end of Q2. The widening fiscal deficit and the government's efforts to try to plug that and to fund that, as well as the fragile macro environment. So that should all culminate in yields moving upwards in the second half of the year. Consequently, I'm expecting average yields on bonds to trend upwards, maybe to around 7% levels, while the yields on NCV will go from the sub 1% levels to maybe around 1%.
Yeah, so talking about drivers now, will this movement be driven by the local or foreign investors?
Yeah, that's a great question. I mean, the locals don't really have much of a choice but to play in that market with the way liquidity is at the moment. And so it is likely that, we should see them continue to play there, but not, not as actively as in prior years. But on foreign investors, I mean, the low level of global interest rates should ordinarily have been a boon for Nigeria and for the Nigerian fixed income market. How monetary authorities in global markets have pushed a lot of liquidity into their economies, should have seen that a lot of flows should have been directed towards markets like ours with better interest rates. But those investors tend to look at countries that have strong macro fundamentals, good democratic standards, strong institutions. So, I mean, given that the current yield environment in the country relative to peers, the likes of Egypt, the likes of Kenya, Ghana, who have better interest rates than we do at the moment, policy flip-flops by our economic managers, and just a general lack of forward guidance from our economic managers were likely to be bypassed when it comes to attracting foreign flows. If you further contextualize this by looking at our expected or our view of expected capital repatriation that is going to happen in 2021 out of Nigeria because of our persisting FX liquidity issues, it just signals more market pressure in 2021.
Now, Obey, a very quick one before I let you go. Within the equities market, how should investors be positioning?
Yeah, I mean, the equities market, I think it's going to be a tale of two halves as well. For the equities market, we should see an extension of the bull market in the H1. This is as, we should start seeing an earnings recovery, the elevated liquidity position, low interest rates, obviously attractive dividend yields as well. But we should start to see a reversal once FI yields start to go up. So in terms of how investors should be looking at, we think that, investors should look at stocks that are trading at low valuations, low valuations compared to historical levels anyway, stocks with attractive return on equity, probably above 20%, stocks with strong growth prospects. And there are some key sectors that we look at, like the telecom sector, which we expect, will continue to grow in 2021. It will remain quite a resilient sector. A catalyst for that sector as well is the PSB license and mobile money, which we're starting to see pick up. The likes of MTN are expecting approval in principles from the regulator. The cement sector as well is expected to continue to benefit from strong volume growth in that space. The banking sector and financial services as well, which have, we think that dividend yields in that space are quite attractive.
Obey.
Yeah, good.
Thank you very much, Obey. We do appreciate your time.
Thank you.